Banking crisis still brewing. Regulators worry about shadow banking. The banking crisis in Europe and the United States is still ongoing. More than a dozen global regulators, investment banks, asset management institutions, and former central bank officials surveyed by foreign media have begun to worry about shadow banking, that is, private equity companies, insurance companies and pension funds, bring about a new round of volatility. In their view, there is a hidden risk in credit from these institutions. Given the enormous hidden leverage shadow banks have quietly built up over the past decade, worrying, according to those surveyed, is how the debt of private equity firms and other asset managers, among others, have been allowed to ramp up cheap lending at the same time that banking regulations have tightened following the global financial crisis. Nor is it adequately supervised. Although each loan may be small, they are often structured in a tiered fashion, with the result that investors and borrowers can suffer losses if banks or other credit providers suddenly withdraw loans. Ludovic Philippou, a professor of financial economics at Oxford University, said, "A small economic downturn and higher interest rates will cause some companies to default, which will make the shadow banking institutions that make loans to them difficult, and then let those shadow banks provide leverage. Banks are in trouble." Indeed, earlier this month, the collapse of Silicon Valley Bank, a major provider of financing to venture capital and private equity funds, took on more urgency about the potential risks of shadow banking. The troubled Credit Suisse Group, which followed closely behind, also provided various forms of credit lines to these shadow banking institutions. Fortunately, these banks have all been rescued, but regulators and market participants are worried that if similar credit institutions are not rescued in the future, it may trigger wider contagion. Foreign media quoted a former Bank of England official who requested anonymity as saying that the decision of U.S. regulators to provide guarantees for depositors of Silicon Valley Bank tends to make everyone ignore the systemic risk that the bank may bring. That is, its impact has spread to wider areas. Potential risks of widespread shadow banking. Unlike banks, private equity and credit funds are more resilient in crises because, unlike bank depositors, investors in these institutions tend to favor long-term investments. But another former BO official said ignorance of the potential problems and vulnerabilities shadow banking could pose to the financial system worried regulators. Private lending will be a key area of focus this year, the regulator said, with assets under management expected to double to $2.7 trillion by 2026. According to foreign media, citing another official familiar with the matter, the recent turmoil in the banking industry may lead regulators to conduct a deeper investigation into global shadow banking loans, including credit provided by private equity firms, insurance companies and pension funds. That means regulators first need to find out where some of the problematic assets went after they were stripped off banks' balance sheets after the financial crisis. Regulators also want to examine the credit risks banks may have posed by lending to takeover companies during the alternative asset boom, the person said. To sort out those potential risks, he said the Bank of England plans to conduct its first stress test of shadow banking institutions, including private equity firms, this year, with further details expected to be announced later. Not only the British regulators, but the top financial regulators in the United States also stated in February that they would consider whether to include some non-bank institutions in the list of systemically important institutions and implement stricter supervision on them. The Financial Stability Oversight Council will bring non-bank financial intermediaries back into its priorities for 2023, according to a statement from the U.S. Treasury. The Fed, FDIC and Financial Stability Board declined to comment. European Central Bank Vice President Luis de Guindos also warned in an interview with foreign media published on the ECB website on Sunday that non-bank institutions take a lot of risk in the era of low interest rates. Potential vulnerabilities could surface as monetary policy changes. Debt has always been a big part of the business model of private equity firms, but in recent years, institutions at every level of the food chain in the private equity market, from the private equity funds themselves, to their management, the businesses they own, and even their funds, investors, all kinds of leverage are available from banks these days. Some people familiar with the situation said that compared with the scale of leveraged loans in circulation before the global financial crisis, the current scale of each loan in shadow banking is actually small, but various institutions provide various types of leveraged loans at various levels for foreseeable events. banks withdrawing loans sharply may cause serious pressure on the entire shadow banking ecosystem. Foreign media quoted a former Bank of England official as saying that a worrying issue is that if one part of the ecosystem becomes volatile, unable or unwilling to lend or buy assets, the overall credit conditions in the ecosystem will be affected, tighten quickly. In fact, even before the recent banking turmoil, some institutions had begun to re-examine their exposure to the shadow banking sector. Armin Panashin and Danielle Pauly, managing directors at Oaktree Capital Management, wrote in a memo. In January, some banks were already reluctant to provide more leveraged loans to some non-bank institutions. At the same time, some private lenders have also drawn back sharply their lending scale due to falling revenues, falling profit margins and high input costs, some of which have stopped issuing new leveraged buyout loans. At present, as debt funds, other banks, and institutional investors are still willing to deploy additional capital, the situation that some banks have withdrawn their leveraged loans to non-bank institutions has not yet resulted in a lack of financing options for non-bank institutions. But a person in the loan business at an asset manager said banks had been trying to dump positions in leveraged funds since around September last year, which worried him because it was the first time he had seen such a situation. Asset manager VGI Partners Global Investments Ltd. said in a letter to investors at the end of January, warning signs are flashing in the shadow banking sector, a completely unregulated segment of the financial opacity factor. Private equity funds could prove to be a hidden risk in the system. According to an investor survey released by Bank of America last week, respondents believe that systemic credit events pose the greatest threat to the global market, and the most likely source of threat is the U.S. shadow banking. Martin Grunberg, chairman of the Federal Deposit Insurance Corp., and Larry Fink, chairman of BlackRock Inc. In recent public comments, both China and China have called for greater scrutiny of shadow banking.